Hi, I'm Peter Rose, founder of Longwood Currency Trading. How to build consistent results trading Forex. That's what I'd like to talk about today. I'm inside. I just got in from dragging in several cartloads of wood for the wood stove. It's 2nd of February of 2024 when this video will be released. It's a cold day, and so we got the wood stove going and ready to go. So we're in the kitchen here. I like to record in the kitchen because we have such a beautiful area that I live in. It's nice to be here. It's nice, bright and sunny, and I'm in my library all the time anyway, trading or doing stuff, so it's nice to get out and do these videos somewhere else. It's a pretty dark, cloudy day today, and it's I know you can't see it through the window, but it is snowing lightly, and we're supposed to get a couple inches tonight or tomorrow or something like that. We've had days of rain and sleet and snow and all this other stuff here in New Hampshire, in New England, in the U.S. East Coast, and so it's common for this time of year. Trading should be that way too. It's common. Your practices should be common in it. So how do you build consistent results in your trading? For first of all, why would you want to have consistent results? Why not just have them shit all over the place? The consistency enables you to calculate metrics that will help you later if you have somebody that can explain how to look at those metrics and break them down into equations. But it will provide you the metrics that will tell you where you're deficient in your trading, whether that's part of the entry analysis that you're doing, whether you're having issues in position management or exit methodology. So that it's the consistency of your trading that enables you to see where your strengths are, where your weaknesses are, and then when you do something really stupid, or maybe you don't even know it's stupid, but it doesn't go well for you, you can look at that trade carefully on your chart. You kind of backtrack through that as to, well, why did I take the trade? What was going on at that particular time? Consistently, I'm a consistent trader, and I've seen this type of thing before. Why did I fail now? And you can look at the chart and your past actions. If you're staging, that's even more valuable to you because you can find out, well, did I start to go wrong or make misjudgments when I was building the position or when I was staging into the position or whatever. Again, this video isn't for a beginner. It's more for intermediate and advanced trader, low mid 5-figure account, getting ready to trade multiple lots, 3 to 5, getting ready to go to the 8 lot level, something like that. However, you need to be aware as a beginner of the importance of being consistent in your trading and understanding that those consistent results produce metrics, and it's those metrics that will help you to trade. So how do you become consistent in your trading? Let's back up, and if you're an intermediate or advanced trader and you're not having the results that you feel that you should be having, this could be one of the reasons for that, is that you didn't start out the right way. In the beginning, I always advise folks not to trade for dollars, but to trade for pips. That's the only, and to be all in, all out. Don't have a 5 mini lots and you're staging 2 in and all the other rest of the stuff, or even 3 lots and you stage 4 minis as you come in. And if you're, even with your account at a 5 lot capability, you shouldn't be building positions and staging into them and breaking that 5 lots up, because you're losing the value, you're losing the power of that 5 lots to generate a nice return for you. When you get to trading 8, 10, 12 lots positions, then you can enter the position with 5 as you did before, and then you can build into it with another 3, so the position only goes maybe 5 points for you. In other words, it's run out of gas. You've got, 8 lots, $80 a pip. You've got a $400 profit there. So that would be like a default value for you that you trade every day, and maybe you make $700-800 on average. Sometimes you're getting $1,500 for a trip or whatever. So it all averages out to some value, but at least you make $300 or $400, even on your weaker trades, let's say. They do bring the average value of winning value down, but that's okay as long as when you trade, I mean, if you lose, you're going to lose at entry, right? You're going to lose. You're trading 5 full lots, and you have a 10 pip stop. You're going to lose. You know, you're going to lose $500. That's that. But it's later in the game as you go into position management and stuff. The foundation that you build in that entry analysis determines, even if you're not breaking in the position into building and staging in, it still determines that consistency of your trading and stuff determines how far you're going to be willing to push that trade, how willing you are to take a small backtrack and hopefully to have the thing turn around and continue in your position. If it takes a backtrack, you have this thing in your head where you say, well, I've got a successful trade here. I don't want it to fall any further than this because it's $300. So at least I want to make a $300 profit and get out of that, to get out of that trade. I don't want it to go all the way to zero and say, oh, okay, I'm going to get out. Because you took all that risk to what, go to zero, to jump ball it, break even? No, you gotta ring that cash price. You gotta make some money, even if it's only 1 pip. But to try to strive for a $300 gain once you're trading larger lot sizes is a wonderful thing. Because if all you made was $300 a day, 5 days a week, that's $72,000 a year. So if you can figure out how to do that on a 3 lot, that's great. 10 lot is probably a better bet for something like that. But regardless, you are able, because of the consistency in your trading, to be able to say that you're going to do that. If you're not a consistent trader, how would you ever know what you're capable of doing? Because your results are going to be all over the place. And so when you start out trading, you're all in, all out, and you're not trading for the dollars. You're not trying to pay your light bill. You're trying to say, how many pips for the currency pair that I'm trading, the time of day that I'm trading, the time frame that I'm trading on, what is a reasonable expectation of the number of pips that the average position that goes into success will make? We don't have any control over that. The only thing we have control over is our loss. And so you have to determine ahead of time whether you're going to be like everybody else and say, oh, I'm going to make my loss point determinant on the structure of the thing, or it's going to be a percentage of the amount risk, or reward to risk, all this other horse shit that's out there. There's a better way to do that. But you need to understand where your risk point is in relationship to your gain. And it isn't risk to reward ratio stuff. In any event, you're striving for consistency in your ability when you win to make in the money positive pips. You're not interested so much in what the dollar value of that is. If you're only making 2 pips, but you're consistently making 2 pips, that's going to give you some important information when you decide to step up your bank as to how much you're going to be wanting to risk on that opening entry trade that you make. It's going to determine whether you want to step up in lot size, because if you're only making on average that 2 pips, you may want to rethink your entry analysis because you're getting in too soon probably to the trade because it's going back against you and you're getting jumped out at that 2 pip point. Or you have more of a fear of letting that price just run and retract back and lose the gains than you are in natural tendencies to let the losers run. Well, you have to resolve that. I can't help you if you can't resolve letting the losers run. If you're going to let losers run, you're going to go to the wood at some point on your account. There's nothing I can do to help you with that. However, the consistency is, oh, I'm trading, and over a month's period of time or a couple of months period of time trading, I'm getting 3 pips a day. Okay, now you're consistent. You have some kind of consistent basis, and you can now start asking yourself some questions. The main one being, why am I only getting 2 pips or 3 pips? And then if you have crafted trading rules, which you're doing as you're learning this consistency, because you can't change the way that you trade and then at the end of the month say, oh, I'm consistent. If you change the way you trade, if you change where your stop's at, if you change profit target analysis, the process of how you determine where your profit target is, if your average win value on a well, say on a weekly basis is just all over the place, that's not consistent trading. So if you're not consistent in your trading, you're not going to get good metrics. I mean, you can fade yourself and you can trade for 2 or 3 months and catch a big run in the market. You know, maybe the some bitch goes up 400 pips and you're grabbing pieces of that, and so you end up making 70, 80, 100 pips of that, and you're a freaking hero and you're a consistent winner and all this other kind of stuff. And so you delude yourself into thinking you know what you're doing, and you really don't, because when the price flips around and goes in the other direction, you're constantly going to be trying to second guess that, because you're going to want the price to go up, but it's going down. You can't change your mindset because you're top end biased, and the whole thing will fall apart on you. So you have to do this over a long enough period of time so that you meet different situations in your trading. And that's why I say you can't really learn how to trade on the longer time frames. How many times are you going to lose? You only learn when you lose. So if you're trading on a daily time frame, you're going to be trading what, once a week or once every other week or something like that, maybe even less. Well, you know, come on. As a day trader, you know, I could make, if I'm trading small lots, you can almost go on the scalping thing. So I'm going to do 5, 6, 8 trades a day. Well, you wouldn't hit 5, 6, 8 trades in 4 months if you're trading on the daily chart. And you're not going to learn where your pain points are with your price retracting against you. If you're going to sit there for 4 days, price could go 200 pips in either direction. And one of them could be a part of a trend, and the other one could be a reversal to that trend. But you're not going to know, because you're going to get taken out at 200 pips, or you're going to get, maybe you'll set your stop as a trail, and you'll get out losing 20 pips on your retracement. And then what are you going to do? You're going to sit there for another 3 days waiting for an opportunity to come to make the next trade? Or worse, oh, I didn't work out on that pair, so I'm going to switch and go to another pair. There's no way that you're going to learn how to be a consistent trader by doing any of that. You trade one pair, one time frame, hopefully one time period during the trading day, when you're always going to have that opportunity to trade. If you've got to get out the door at 7 o'clock in the morning to get to work, then you got to get up at 5 o'clock so you can trade for an hour and a half. And if you're doing that on a day trade basis, I mean, you're not going to make a lot of money on a one lot at $10 a pip, right? You make 5, 10 pips, you're making $50, $100. I mean, that's okay as a percentage of that at $10,000. But if you could do that every day, if you could make $25 a day, 4 days a week, you're making $100 a week. Plenty of money for that size of bank that you're going to have on a yearly basis. But it isn't going to, like I said, it might pay for your light bill, but it's certainly not going to get you ahead once they take taxes out and you do all the rest of the stuff that you have to do. What's the net money left in your pocket? You're looking at the long game here. Why are you trading? You're trading so that you can buy a Lambo, right? Oh, I mean, you do whatever the hell you want to do with your money. If you're 20 years old, 25 years old, yeah, play for the Lambo. It doesn't make any difference. You'll end up doing trading and doing really well. You'll buy the Lambo. You get a couple of $100,000 invested in the Lambo, and it's going to cost you $600 to change the oil, and you'll lose your account, and all of a sudden you won't have $100,000 a year coming in from your trading. You'll have nothing coming in, and you won't have a job because you will have given your job up. Now you're living on savings. $600 for an oil change in a Lambo. You're going to run out of money really quick. So you do whatever you want to do, but not only do you have to be consistent in your trading, but you better be consistent in your lifestyle as well, because in the end run, consistent trading will make that lifestyle grow and grow and grow and grow as you progress on ahead, as long as you don't try to be more than what you're capable of being. So how do you develop this consistency in your trading? Develop a plan. I mean, if you're going to learn how to drive a car, they teach you how to develop a driving plan. This little octagonal red thing with a stop on it, when you approach it, you stop there. You look to the left, you look to the right. The guy on the right's got the right of way. Make sure there's no little kids dribbling a basketball in front of you. You don't even have to be in the car in order to be taught that. So that's dry labbing the car learning experience. And you learn that, and then when you get into the car, you'll be thinking about those major things that the driving instructor taught you. It's very difficult in Forex trading to do that, because most of the people that are out there that are teaching this stuff don't do that. They try to teach you everything. We don't need to know everything. You just need to know the 5 things that you better do in order to be consistent in your trading. If you're trying to do all of this stuff, then we're going to use a Bollinger Band, I'm going to use an RSI, and I'm going to do this, I'm going to trade at London Open, and I'm going to, whatever it is you're going to do, you're just going to be so totally confused you're not going to know what to do, because you're not trading, you're using a system. And the systems don't work. They invalidate themselves after a period of time. A simple example is you're trading a trend following system. What happens when the trend breaks and you go into a chop or a reversal and you go into a range bound price action? Everything that you learned to trade the trend, you'll get chopped up, and you'll go through an account really quickly, because you won't believe it. Well, let's say you learn to trade in a range. What happens when that range breaks out and the price keeps going? You're going to be getting out of the trades at profit targets that shouldn't even be profit targeted. So in this developing consistency in your results means that you're developing consistency in your trading, not consistently applying some system. So you have to back up from the thing, just like we do in a driving lesson, and look at the market, look at the pair that you're going to try to trade, and when you're going to trade it, and what time frame you're going to trade it, and study that. And the most important thing that you want to come to as a conclusion is, if price gets going in a certain direction, how far does it normally go before we'll get a reversal, a retraction? If it's, let's say it goes, you're trading a major, of course. You shouldn't be trading crosses or exotics or whatever. Spreads are too big for you. You won't be able to develop good metrics with spreads like that. So you got to trade one of the 6 majors, because that's 85% of the market. You want to be in a liquidity situation. That's why you trade in the majors, to learn. And then later, if you want to trade, some exotic pair, go ahead. Try it at 200 to 1. And that's another thing you're going to do in order to be consistent. You cannot be trading at 200 or 500 to 1. That's insanity. It's crazy. I have folks that send me an email. Now, this is what I'm doing. The first question I ask is, what level are you trading at? If they tell me it's 200 to 1, I say, I'm sorry, but I can't help you, because you have corrupted yourself into wanting that action to trade at 200 to 1 or 500 to 1. For somebody who's really, really experienced, trading at that level is fine, because you know how to balance your risk. But as someone with that hasn't developed consistency in their trading, who doesn't understand how to trade, that's just the kiss of death. I'm an experienced trader. I've been trading live accounts since 2012 in the Forex market. I've been studying the Forex market since 2007. I've been studying the financial markets themselves since the mid-1970s. I trade one pair, one time frame, and I'm at 10 to 1. If I'm going to trade one full lot, I'm going to have $10,000 behind it. Not $7,000, not $5,000, because, well, we got to pay margin here in the United States. There's a reason for that you have margin. There's a reason that you can't trade more than 50 to 1 in the United States. Those rules are there to protect you, just like in the stock market. You've got a no short rule on a drop. There's a reason for that. There's a lock limit in the futures market. There's a reason for that. Those rules are there to protect you. The fact that you're pushing the envelope and you get caught in those things, well, you know, that's you have to figure those things into your loss calculations if you're going to trade those markets. That's why I like the Forex market, because you don't have any of those crazy things that you have to do. I don't trade at 50 to 1 even though I could. I trade at 10 to 1 because my rules are based around a very consistent approach, a very safe approach, and it sets it up for a time when I can push it all to the center of the table and run with it. And by running with it, you get a 5 hit or a 7 hit against that. So I'm trading 8 lot capability, and I'll get 7 times the normal value of whatever that normally would be based on my average win rate. Okay, those are metrics. That's why the consistency in the trading is important, because it builds those metrics so I can say shit like that. But if you are so wound up that you can't just slow things up just a little bit and take a few steps, just like you would if you're going to learn how to drive a car, just think back to when you were learning how to drive a car, as to what you would need to do in order to set up your trading plan so that it works toward consistency in pips, not in dollars. And I think you'll find that your trading is really going to benefit from having that kind of discipline. Because later, when you understand how to trade, you can really push the envelope on this stuff and you can make a lot of money. But you're not going to make a lot of money unless you start out understanding the importance of having consistent trading results, and you understand the mechanics of how you got to that consistency. Okay? All right. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.